Good morning, traders, and welcome back to today's daily analysis. Today is September 2nd, 2024. And starting off with the US dollar, fell to 100.51 early last week, the slowest since July of previous year, but rebounded to 101.70 by weekends as traders adjusted their expectations for sharp Fed Reserve rate cuts. The dollar ended at 5-week decline, supported by the positive US job market and GDP data, indicating a potential soft landing for the economy. July's inflation, measured by the PCE index, held steady at 2.5%, while the core PCE, excluding food and energy, rose to 0.6%, slightly below expectations. Despite this, the US dollar remained steady, reflecting uncertainty about the future rate cuts. The US dollar index may be repeating its 2023 July pattern, where it dipped below 100 before a strong rebound. For a continued recovery, it must break through the key levels at 102 and 102.14, which is 38.2% Fibonacci retracement. If it surpasses 102.65 at 50% retracement, and the 30-day moving at 102.78, the next target is the 104 area, which aligns with the 200-day moving average at 103.95. The support is at 101.14 and 101, with the drop below 100.61 potentially leading to a test of the 100 level. And then for the crude oil prices, hovered around $75 by the end of last week. After a midweek surge, the market is now closely monitoring the political unrest in Libya, which could cause a short-term supply shortfall of about 1 million barrels per day. Additionally, the Houthi rebels released footage of an attack on a Greek ship in the Red Sea. However, oil prices dipped below $75 after a report suggesting that the OPEC would increase supply starting in October, ruling out any delays in planned production cuts. This has raised concerns about the oversupply. And for the technical analysis, the WTI oil prices experienced volatility last week, rising sharply before being capped at 200-day moving average at $78.07. The price failed to challenge the key resistance levels at $79.90 and $80. The 14-day RSI remains below 44, indicating the increased downward pressure. If the prices fall below the key support at $74.88, the next target is 73.21 and 72.10. So to maintain the upward trend, the oil must hold above the $75.50 with 77.55 aligning with the downtrend line and the 200-day moving average at 78.07. And then lastly, for the gold, last week the prices closed likely lower by 0.40%, but managed to hold above the 2,500 ounce mark. This week, the market attention will focus on the upcoming US ISM data, the non-farm payrolls report, which could spark significant movements in the gold market. The gold briefly dipped below 2,500 last week due to the US dollar recovery, but quickly rebounded. The release of the US inflation data, such as the July PCE index, showed a 0.2% rise in prices, aligning with the expectations. This positive sentiment weakened the precious metals slightly, suggesting that a hard landing of the economy is unlikely. Technically, the bullish trend for gold remains intact, with the prices continuing to trade in the upper half of the upward channel since mid-February. The 14-day RSI is around 57, indicating strength, and the short-term support lies in the 2,500 to 2,494 ounce range, with further support at 2,475 for the 20-day SMA. A daily close below 2474.5 could lead to the decline toward 2450.20. On the upside, breaking above the historical high of 2,531.7 could push prices to 2,544 and potentially target 2,578.2. if the bullish momentum continues. And that is all for today daily analysis. Thank you for watching and have a good day.